Most investors wake up checking prices, assuming calm charts mean safety, but real financial stress usually begins quietly, hidden inside supply chains, balance sheets, and political decisions. Right now, the biggest risk isn't a crashing chart, but a growing gap between how metals are priced on screens and how governments and industries treat them privately. Paper markets still function, ETFs still trade, and quotes still update. Yet behind the scenes, physical metals are being handled like strategic weapons, not ordinary commodities. In my opinion, when something essential quietly shifts from tradable asset to national priority, the price you see usually becomes the least important detail. The recent seizure of Venezuelan gold connected to Nicolas Maduro's arrest sent a message far beyond politics, signaling that sovereign reserves are no longer untouchable inside Western systems. Roughly 161 metric tons of gold disappeared from Venezuela's control, and markets understood instantly that legal justifications matter less than the precedent such actions establish. Countries already skeptical of Western finance saw this as proof their assets could be frozen, seized, or repurposed whenever geopolitical tensions suddenly override financial norms. Russia and China responded accordingly, not with symbolic outrage, but with economic positioning centered on commodities that modern economies cannot function without. Silver, in particular, sits at the crossroads of technology, energy, and defense, making it far more important than most investors casually scrolling price charts realize. This metal powers electronics, solar panels, electric vehicles, medical tools, and advanced weapons. And there is no easy substitute when supply becomes restricted. China controls roughly 65% of global refined silver output, giving it enormous influence if export flows are redirected toward domestic stockpiles or strategic partners. When producers prioritize reserves over open markets, supply tightens quietly, long before headlines or official price adjustments alert everyday investors. That tightening is already visible in physical markets, where buyers reportedly pay massive premiums just to secure immediate delivery of real metal. In some regions, silver trading near $70 on screens effectively costs closer to $140 when purchased physically. A price gap that extreme doesn't reflect speculation. It reflects distrust in paper settlement and urgency from buyers who cannot afford delivery failures. Most people miss how leveraged the paper-silver market actually is, with hundreds of millions of ounces represented through derivatives and contractual promises. Those promises assume metal can always be sourced, rolled forward, or settled smoothly, assumptions that break down once physical supply is ring-fenced. When governments treat silver as strategic leverage, derivatives built on easy availability suddenly resemble fragile confidence games rather than reliable financial instruments. Western banks have every incentive to maintain stability, suppress visible stress, and avoid settlement failures that would expose how thin inventories really are. Eastern powers, meanwhile, gain leverage by challenging Western pricing systems using control over real resources instead of speeches or currency rhetoric. This isn't about short-term volatility. It's about redefining who controls essential inputs for future technology, energy transitions, and military production. While media attention fixates on courtrooms and political drama, the more important activity is happening quietly in vaults, refineries, and procurement offices. Large manufacturers aren't waiting for official prices to adjust. They're locking supply directly, even bypassing traditional exchanges when necessary. That behavior drains available inventory further, making public price signals increasingly detached from real-world conditions. As physical availability shrinks, paper promises lose credibility, and the risk of forced cash settlement or rule changes rises sharply. Market breaks rarely look like explosions. They often appear as delivery delays, revised contracts, or sudden policy shifts favoring institutions over individuals. Understanding this distinction is critical for investors who believe owning silver exposure automatically means owning silver. A digital claim backed by counterparties behaves very differently from a tangible asset that must exist, move, and be delivered under stress. Stable charts can persist long after systems become unstable because confidence can be managed longer than physical supply. Geopolitics now plays a larger role in commodity pricing than central bank speeches or economic forecasts alone. Countries controlling production are learning the power that comes with choke points in essential materials. Countries dependent on imports are discovering how vulnerable that dependence becomes during political conflict. The shift doesn't require dramatic announcements to matter. It quietly rewrites the rules of access and pricing. In my view, the current calm narrative is the most dangerous part, because it encourages complacency at exactly the wrong moment. History shows markets rarely fail because everyone is wrong, but because too many people believe the same comforting explanation. Today's explanation is that prices look normal, therefore systems must be functioning normally. That logic ignores how often price stability is engineered to buy time rather than reflect reality. Investors should focus less on daily fluctuations and more on structural assumptions behind the assets they hold. Ask where supply comes from, who controls it, and what happens if delivery is stressed. Awareness matters more than prediction during periods of systemic transition. This is not a call for panic, but a call for understanding how rapidly asset classifications can change. Metals are increasingly treated as strategic infrastructure, not speculative commodities. When that happens, access becomes more valuable than theoretical pricing models. Those holding only paper claims may discover too late that settlement terms matter more than quoted prices. The world is moving toward negotiated resource access between states, not transparent pricing on public exchanges. That transition favors preparation, diversification, and realism over blind trust in financial plumbing. If you rely entirely on digital representations, understand the chain of promises behind them. If those promises break, resolution may not favor the smallest participant. This environment rewards investors who study systems, not just charts. It punishes those who assume yesterday's rules automatically apply tomorrow. Financial history is full of moments where calm screens masked enormous underlying stress. We may be approaching another such moment, driven by resources rather than currencies. Silver's importance makes it a focal point, but the lesson extends far beyond one metal. Lithium, cobalt, and rare earths could follow similar paths as strategic priorities rise. The broader theme is control of inputs that power modern civilization. Once that control shifts, pricing power follows. Ignoring that shift because prices seem stable is a costly mistake. Smart investing now requires geopolitical literacy alongside financial analysis. Understanding incentives matters more than trusting official narratives. Markets are social systems, not natural laws, and rules can change quickly. When they do, preparation separates protection from regret. Stay focused on fundamentals that cannot be printed, hedged, or endlessly promised. Physical reality always asserts itself eventually. The only question is whether investors notice before or after the adjustment. This is why I emphasize looking beyond headlines and charts. If this perspective helps you see markets differently, make sure to subscribe. I focus on the deeper forces shaping finance, not just daily price noise. Because understanding structure today is what protects capital tomorrow.